There's no shortage of fears about the market and the economy and what's going on there. People are running around, especially when there's heightened volatility. And volatility can have a good side because when wealth grows from volatility, people get really excited. It's just that when it goes down, people start to wonder if their life savings is flying away from them. So today we're going to take a look at volatility, see how normal it is or isn't, and give you an idea of what you should expect going forward. This is Marked Perspectives. Today we're talking markets ups and downs, and I'm Cameron Irvin. This is brought to you by Irvin Wenborn. So it starts here, like you might guess, with a chart. That's always the case for financial people. We've got a few different asset classes of share markets around the world. We've got New Zealand, the rest of the world, and Australia. And during this very particular time period, you can see that the share markets actually rose, and rose quite a bit. And after that, they went down a little bit, and then they went back up, and then they paused here. And this was right around the time of a significant year that was 1987. And that's probably going to stick in the minds of a lot of people because then things got ugly. You'll notice here that the green line shows world shares, which tended to recover relatively quickly. New Zealand, we weren't so lucky, so we had a pretty ugly time, and people lost a lot of money and wealth during this period, which is unfortunate. But this does show a 4 to 5 year period here, and we want to keep in mind the long term, because that's what really makes a difference and drives returns when it comes to wealth. So if we zoom out to a 50-year period, now we can see all of the lines go from the bottom left-hand side to the upper right-hand corner. And there are still squiggles, which represent the volatility that shakes up and down. But over the long term, it gives us a little bit of a better perspective of the fact that volatility is normal, and despite that, wealth still grows anyway. But maybe this is just New Zealand, and let's not have too much of a home country bias, so we'll shift our attention elsewhere to Australia. So in the Australian share market, we'll go back to the year 2020, and that year the Australian share market saw a 2% gain from 1st of Jan to 31st of December. But that doesn't mean that within the year there wasn't some pain, because there was a 36% loss at one point. And that's a big deal. In 2019, though, there was a 24% gain throughout the whole year, but within the year, there was a 6% loss temporarily. These temporary losses are called intra-year declines, and it just means that the market goes up, and then it goes down temporarily before going back up again. And it's a very common experience. So if we look over the other 2 decades, we see that there are a lot of positive returns listed out here, and some negatives. But there's a red dot on every year, and that's quite noteworthy to bear in mind that an intra-year decline is that common every single time. That's only one part of it. Also notice that in 2004 there was a 3% decline, but 2008 saw a 45% decline. There's a big range between those, and 45% is pretty painful to live through. But noteworthy here is that 16 out of 20 years, or 80% of the time, there was a positive return in that year. This kind of shows us that the best strategy is really going to be a buy and hold. Invest the money, don't make many changes when there's volatility, because it's better to keep it as is. Also bear in mind that in 2020, with a 36% decline, that was due to COVID, and that's an extreme event, but it still ended up being a positive year. But maybe this is just Australia and New Zealand and oceanic countries, so we want to be a little bit more global in our perspective and take a look elsewhere to see if this applies in other markets or other parts of the world as well. So we'll turn our attention now to the US and look at the S&P 500, which is one of the biggest indexes in the US. And we see here that there's a lot of positive years for calendar year returns, and then there's a few negatives as well. And then we have a bunch of red dots, which are the intra-year declines, and I again kind of have to notice that every year has got declines within it. On top of that, we also notice that every intra-year decline averages 14% or a little bit more, but despite that, 3/4 of the year still end up being positive. This reiterates the buy and hold approach and the fact that the volatility is the price to pay to see that money grow over the longer term. So there's other ways we can look at this data, and if we look at the Dow Jones Industrial Average, it's another US index, and tracking from 1950 to 2016, we can see that on average things have gone up. But There's also been some dips, especially around 2008's global financial crisis was a pretty brutal time. But despite the fact that on average things have gone up, that doesn't mean that they're always up. In fact, a lot of the time, the market goes up and then back down, which we've seen, but how much of the time is highlighted in gray. That shows that the vast majority of the time, the market hits a new high and then drops even about 5% below that, which is a pretty big amount. That means if you put $100 in at the peak, it's going to be about $95 for the majority of the time until it goes back up to a new high point. So some key takeaways for today. Number one, volatility is an entirely normal part of investing. It's something that we should be used to. The fact that things do go up and down is a regular fact of life. Secondly, I'd say that drops might be scary. I'm not saying that they aren't frightening, but that doesn't mean that they should actually be surprising to us. Given how common they are, they occur at least once a year and sometimes even multiple times. Also, because of that, the less often you actually check your balances or accounts, the less pain you'll feel. We've just seen that most of the time things are not actually at a high point, so it looks like they've dropped temporarily, and that's painful when you think that you're losing money even when you're not. And then finally, a long-term focus is always going to be important when it comes to investing, because that's going to help us make better decisions financially for the future. If you enjoyed this video and would like to see others like it, reach out. We'd always be happy to connect, and you can find us at irvinwinborn.co.nz or by email and LinkedIn.